Now, as we turn to the U.S., one of the things that I always like to look at, and it's frightening, but record high in U.S. are putting off medical treatment due to cost, and that's which is true. And I know this is just something that my wife was really sick. She was coughing a ton, and she hurt her side, whether it's a broken rib or not whatnot. And she was just trying to go just to see a doctor, and it was going to be 4 weeks. And he said, well, if it's really that bad, just go to the ER. And it's like, well, based on our plan, which is Obamacare, which is obviously terrible, you have the cost of going to the ER would measure something in, let's call it anywhere between 700 and 1,200 bucks versus her going to her practitioner, where they were like, oh, well, it's going to take time. So then she's like, well, I don't have time for this. And maybe it's better by then. So she has the appointment just in case. But this is a problem. And when you start thinking about people avoiding medical treatment because of time, because of cost, that's when you start to see an increase in underlying insurance costs, because people aren't doing early intervention. They're not being proactive. And then when you do catch something, it's further down the line. It's going to take a higher price to fix based on treatments and whatnot. So again, there has to be a way to do this better. And I know it's an open-ended question to kick off segment two, but it's a big problem. And when you start looking at it, where 38% of Americans have reported that they or a family member postponed medical treatment in 2022 due to rising costs, up from 26% in 21. And I can guarantee you that is going to climb. And the thing that's unfortunate and frustrating, when you look at it, this poll goes back to 2001. We're at the worst we've ever been back over the last 22 years. And now, taking that and looking at that cost, and then looking at the wage growth tracker, the 3-month moving average of median wage growth has slowed, and you're seeing it roll over a bit. It's still at a record level going back to 1997. But again, you're starting to see some of these cracks. And if you get kind of inflation flatlining a bit and cost flatlining, because if wages continue to come down, but your price at the food store, at the services that you pay for don't come down too, well, again, you're just going to see those pain points. And we're going to show you other data sets in terms of debt for the credit cards, and how that is only going to hurt the U.S. consumer further. So now when you look at U.S. PMI and global monetary policy, you get an idea that as global monetary policy continues to tighten and central banks do what they do, well, the U.S. PMI is also going to continue to come down. And that's a fear that we continue to see overall. Now, when you start looking at the U.S. 10-year versus the 3-month government bond spread, you can see just how bad it has gotten and what that means for a recession. And again, this is that leading indicator, but you also have to look at what is happening with the politics side as we go towards another debt ceiling. So the U.S., for those that don't know, has a debt ceiling. There's only a limit to what we're allowed to borrow, and it's become a political tool. And that political tool is usually used or wielded by whomever's in control of the House and Senate at any given time. So now, given the fact that the Republicans have taken the House, the Democrats still have the Senate, you're going to see this fighting, and everyone's like, oh, there's not going to be negotiations. We refuse to negotiate. No, there will be negotiations. What is going to be the given up on spending in order to get this through? It'll pass. The problem is, are we going to have a government shutdown for a month, or I think it was 3 weeks the last time, like we did like we did in 2000, I think it was 2018 or 17 or 18. Again, it's going to happen. It's going to put more strain on anything. We know it's going to get kicked the can. We can't, both sides, Republicans and Democrats, still love to spend on different things, but still spend. So they're one hand of the same body, and nobody's willing to cut spending. So again, we're going to have a lot of, the deficit's only going to get worse. It's going to continue to put pressure. And as rates go up, the cost as we look at where, as this, obviously the spread has gotten to this point on the government bond side, once this snaps back, our costs and interest expense is only going to continue to get worse, because not only do we have to roll debt, we have to issue new debt. The average amount financed for new car loans at finance companies, you can see going back to 2007, you could see that this is the most ever used to buy a new car. And that's a problem because a lot of those cars no longer have that value. So now you have more people underwater. So if anything happens to that car, they're going to owe, the insurance will cover the current value, and there's going to be that disconnect, which is going to be a bigger problem. Total merchant wholesalers, when you look at where it is, you can see inventories to sales ratios going back up. So again, people are sitting on car loans that the car no longer covers the loan, and you're seeing people again slowing down. This is not a good situation when you look at inventories to sales. And we're going to show you another chart from the Small Business Association showing that inventories are rising again, and it's January. You should have been able to get rid of some of these inventories at the end of last year, but as we saw, the retail sales were abysmal, as we said they were going to be, and this is going to become a bigger problem, and it's going to result in more deals and sales to try to move some of this inventory into the market. Now, obviously, we've had some people wringing hands saying that, oh, look at inflation. Inflation has slowed. Well, core CPI was still higher, and core CPI is the one that matters the most. But then when you look at median CPI, trim CPI, sticky, it's all showing you that, well, they're still higher than core. And the problem is we see that, again, acting as a way to, and it's going to pull all of that capacity back up. So we still see a lot of stickiness on the core side. So yes, flexible is going to come down. We had gasoline prices come down. We had diesel prices come down. So that was a benefit for the flexible side. But everything that you spend, food in the food store, your rent, your cable bill, your cell phone bill, all of these things, insurance has all gone up. That's not going down. Like, I would love to get a reduction in my car insurance or in my healthcare. I mean, who has ever seen their healthcare costs go down? Their car insurance go down unless you move, and obviously that's a possibility. But again, these are things that eat into what people have sitting in the bank. So then when you look at that sticky consumer price index, it went back up. And that is a problem, that when you look at the stickiness in that CPI, it's accelerating back again. You had a little bit of a pause and now another bounce. Total consumer credit owned and securitized, we are now back above trend and again back at a record level. All of this is coming at a higher cost. And we're going to have a chart in a few minutes looking at, well, what is the interest expense on this credit, because it is at a record price. I think it's now over 19% on average. PPI Final Demand month over month came in at negative 0.5 versus the estimate of negative 0.1. When you look at last month, remember, it was positive, and that was a surprise to the upside. But core PPI is still positive. So it's the largest drop in headline PPI, which is a positive. I'm by no means saying it's not, but the core side didn't go down. And when you look at where are people going to feel the most pain, it's going to be in that core block. Now, we can go through the math on how it's calculated. Our assumptions going into the year-over-year number was that we were going to be at about 6.7 to 6.8% inflation, but we came in at 6.5. And again, a lot of that was driven based on some funny math when you look at housing, but it's a positive, but you're still, again, it's mathematical, because last year, when you look at the year over year, January of 2022, we were running to the hills when you look at inflation. We were going parabolic. And now, so that comp is much easier, but month over month is still going up. Core still going up. So things are getting better per se, but once you dig into the numbers, there's still real pain to not only the corporate side, but also the consumer side. Disinflation is obviously the name of the game. As you look at December PPI coming at 6.2% versus the estimate of 6.8, and then the prior had that surprise to the upside, but then core came in at 5.5 versus the estimate of 5.6. So still having it, and then going back to 2011, obviously you can see it is still at the higher end. So then when you look at retail sales, December retail sales came in at negative 1.1% versus the estimate of negative 0.9. So when you start looking at the control group, came in at negative 0.7 versus the estimate of positive 0.3. That, again, is where we're start really seeing those impacts ramp up, given we're still just starting to roll over. But there is a lot of downside when you start looking at this. Control group sales used to calculate gross domestic product, excluding food, auto, building materials, and gasoline stations, declined 0.7% in December. The consensus expected a pullback of 0.3. They were up 1.9% on a quarterly annualized basis, but it's far weaker than what was prior of 7.4%. So you can see that there was a pullback across the board. And if you take core and you adjust it for inflation, we were actually down 1%. So again, just as we were saying, starting to see it crack. And now we see a much bigger decline as we go through Q1, which is going to put further pressure on the underlying U.S. market. Industrial production came in at negative 0.7 versus the estimate of negative 0.1. Manufacturing production came in at negative 1.3% versus the estimate of negative 0.2. So again, you're seeing that this rollover, which we think is going to accelerate in Q1. Business sales fell 0.8% in November after rising 0.4% in the prior month. And when you start looking at those leading indicators, you have inventories going up, retail sales coming down. So you're starting to get, again, that back and forth of the problems that we continue to see in the market. U.S. Treasury federal deficit continues to track, obviously above where we were in 2021, but still at the lower end, going back through to at the higher end, going back to 2016. And that's going to put more pressure because even though we have this deficit, we actually have less money coming into the market from the government to the consumer. We do have Build Back Better and other types of focus on infrastructure. But when you start looking at the real GDP and the economy-weighted composite ISM, you get an idea of where we're going and how, even though some of the data was better, some of the inflation data was better than expected, there's still a lot of those slowdowns. U.S. weakness becoming more diffused in the manufacturing sector, and you can see just how quickly it happened. And this is what we were trying to say, where it's slowly, which it started to crack, and then it's all at once. And that's where we see some of this aggressive move with U.S. manufacturing new orders expected at negative 1%, came in at negative 1.8%. And that's something that we see continuing into not only December based on when the data is, but also into this year. So the cycle component of the Brave Butters Kelly Index, which just reflects movements that are likely to govern the direction of growth going forward. It's just something that they created, an index created from from one of the federal, I think this one was Atlanta. It might have been San Francisco, so don't quote me on that. I can check, but you can see that it's turning negative. U.S. leading indicators going down. U.S. non-PMI leading indicators. Again, all of this is showing you, again, the direction in which the economy is headed. But, and this is a big but, because when you look, remember when we were talking about, you had the establishment survey, which was outperforming the household survey. And we're like, all right, there has to be a makeup number. And our view is that the establishment survey was overstated. Well, the household survey just had a massive move up in employment. So, and now it's like, all right, well, were we wrong in saying the establishment survey was overstated? And the answer is yes. The household survey was understated. So you still have, and you take this to the unemployment rate and what should be the natural rate, we are still running hot on the job side. And that, again, none of this points to a pivot. You look at it, inflation is still over, core inflation was still positive going higher. Employment is still running hot. where's the pivot? Where's the cut? U.S. labor force participation is still very low. Again, that's why we continue to see, if we had labor force participation go back to where it was pre-COVID, that unemployment rate would change very quickly because now you're recognized as such. But when you look at where that pressure is, you can see it's in those key areas, still remaining very low, well below where it should be, which is why we're going to see this labor side remain the way it is and wages stay a little bit elevated. So U.S. average hourly earnings, the survey was for 5%, came in at 4.6%, but still above pace. And when you look at the jobs numbers, well, it's coming down, but it's not going to come down quickly. It's pausing, which is good when you think about inflation and pass through a price. U.S. averagely hourly earnings, production non-supervisor. Here you can see, again, still at the higher end, going back to 2005. It's just that's going to keep some of that pressure on the inflation front, which is what we've been talking about. Average work week for employees starting to come back down a bit. Average weekly overtime coming down because as you get new orders slowing, well, you don't need overtime. So now you're just going to operate with your normal, say you have 3 crews a day, then that could go to 2.7, 2.5. All the while, Federal Reserve consumer credit, commercial bank credit cards is at a record high of 19.1%. So credit card interest rates continue to soar and have passed the peak that was seen in 1985. And we are now, so anybody who's borrowing their money on their credit cards are seeing a massive ding to not only their finances, but how this is going to compound over the near term. Empire manufacturing numbers point to an ISM manufacturing of a 42 to 43. There was a plunge in the New York Fed Empire Manufacturing Survey in January, which sets a grim tone to start the year, as you can see with it coming in at a steeply negative number. Service business activity for the New York Fed fell in January to negative 21.4 versus the estimate of negative 17.6, now at the lowest since February 2021. Employment prices paid and capital spending all fell, still slightly in expansion. 6-month outlook also moved up, but still in contracting, with wages ticking slightly higher. So again, starting to see that stagflationary backdrop. U.S. import prices expected to come down 0.9, went up 0.4. U.S. import prices ex petroleum expected to come down negative 0.3, actually went up 0.8. So again, importing inflation. We continue to see that import of inflation, and that is going to keep. Again, there's the other side to it. You're seeing some of the headwinds to inflation, but this is why we continue to see that growth of stagflation. ISM services PMI expected at 55, came in at 49.6, firmly in contraction. New orders went to 45.2, now deeply in contraction after kind of holding in. And that's where January is going to be a big month to figure out, okay, well, was this seasonality? Did people just go away for the last 2 weeks of the year? Or is this something that's going to be more sticky? And again, we'll get a bounce, but I do believe that new orders are going to stay in contraction, and you will get some growth back into services PMI, but definitely not to the levels that we've seen. Inventory sentiment bounced to back up into 55.9, so into expansion. That's a problem when you look at where inventory is, because we had been short. It had been something that was going to keep people buying. Now you're starting to see that pivot. ISM services prices paid still at 67.6. So yes, it's come down, but you're still steeply in expansion, which is why we continue to see the prices for services going up. And remember, as we said before, service price is a big component of sticky and core CPI. And again, you're still in expansion, and a very elevated expansion at that. Borrowers in the second and fourth income quintiles have increased their borrowing the most. So when you think about it, they're increasing their borrowings as we go into Q3 of 22, because they've run out of savings, increasing their credit. And now they're increasing credit at 19.1% compounding interest rates. To give you an idea of just how quickly any of this cushion can just disappear, with revolving consumer credit owned and securitized coming right back into this elevated level. Johnson Redbook sales growth continued to ease. Sales grew last week by 5.3% year on year, slowest since February of 2021. So again, you're still seeing that slowdown, and it's just showing how it continues into this year. Households feeling the pinch. So credit cards or loans, more Americans are relying on money outside of their regular income sources to meet spending needs in the past week. So again, this is why we continue to see that the savings data is grossly overstated. If there was all of this additional savings that was still available, you would not see the credit cards moving at this direction, given the fact that interest rates have exploded on the credit side. Given where credit is, why would you ever borrow additional? So again, some of these issues that we continue to look at. Revolving consumer credit, as you can see, moving to the highs. And then when you factor it in for inflation, it is still fairly muted, but quickly rising to the level. Most important thing for small businesses, you'll be surprised to know, is inflation, and it's going to continue to be such. But when you look at the consumer price index for all shelter as still where it is, worth average hourly earnings rolling over, again, it's unsustainable to have rents and mortgages where they are, which is why we see more downside on the real estate front, which is where we're going to see that pressure. Trim mean PCE from Dallas, as we've been saying, has been elevated, rolling over, hopefully having peaked, but you're still seeing it again stuck at that elevated level. And it's just showing where this trim PCE, how important it is, where it's stuck. And that's why we see that pulling that core back up. Federal Reserve consumer revolving credit through November 2022, revolving credit was up 16.9% year on year, a step up from 10.3% and in the higher range over the past decade. And then when you look at financial conditions, recent tightening in financial conditions over the past 30 days hasn't been nearly as aggressive as before, which again is something is concerning the Fed, because they want to see that move higher once more. So that's what we have for you. I should say tighter again. So that's what we have for you right now. In the next segment, we're going to go deeper into the small business data and other components of the real estate sector.